As the crisis in Europe continues, its eastern neighbors and their banks are feeling the heat. One way the Eurozone troubles are spreading eastward is through cross-border banking. Most banks in the East are subsidiaries of Western European banks, so when funding and capital gets tight for their parent banks, they need to deleverage, which means raising capital if possible, or selling off assets and reducing lending. Here to explain what's happening and what it means for the country's economic prospects, I'm joined by Christoph Klingen of the IMF's European Department. So, Christoph, how have banks in the East coped with this withdrawal of funds from the West?
Well, actually, up until last summer, funding from the West was stable or even rising. But this changed in the second half of 2011 when funding pressures on Western banks intensified. As indicated by the red bars in the chart, the parent bank substantially reduced the funding of Eastern banks, which are mostly their own subsidiaries. But there's also good news. At the same time, Eastern banks managed to attract substantial new funding in the form of local deposits. This is indicated by the blue bars. Now, if you add up both effects, indicated by the diamonds, you see that overall funding increased in most countries. This means that banks had room to make new loans to businesses and households, which is, of course, positive for the economic outlook. This is why the overall outlook for the region is subdued, but not too gloomy either. We project growth to decline to 2.8% in 2012 compared to 4.7% in 2011.
Christoph Klingen, I'd like us to look at a few examples. Poland and Bulgaria. Let's zoom in on them. What's happened?
Well, in both countries, banks' funding loss from the West was more than fully offset by the gain in domestic deposits. So banks had the means to extend new loans, and they actually did. Credit expanded in both countries during this period. Credit growth was stronger in Poland, but this reflects Poland's overall stronger economy and therefore higher credit demand rather than differences in credit supply.
Turning to Slovenia, obviously they haven't fared as well, but why?
Well, Slovenia is indeed in a tougher spot. Slovenia's banking sector has few foreign-owned banks, meaning foreign bank funding comes from non-affiliated banks, and this tends to be a less stable source of funding than parent bank funding. So the pullback of foreign funding was especially large, and the capacity to attract domestic deposits low. The overall funding loss then translated into shrinking credit.
So looking ahead, what do policymakers need to do in order to deal with this very tough economic environment?
I think that deleveraging is here to stay. This means that the challenge is to ensure that the process is gradual and to make sure that the domestic deposit growth continues. Two things are essential in this context: close cooperation with the home supervisors of the cross-border banking groups and steps to strengthen the local banking system. This may involve recapitalization in places like Slovenia, dealing with high non-performing loans in many countries of the region, and generally meticulous contingency planning to deal with shocks to the financial system. Apart from the deleveraging issue, policymakers in the region should persevere. They need to complete the repair of public finances that were badly damaged by the crisis in 2008, scale back widespread foreign currency lending, and bring down foreign indebtedness.
Christoph Klingen, thank you very much for joining us today. For more information on the IMF and the crisis in Europe, visit imf.org.